Welcome to The Explainer. Today we're doing something really fun. We're launching a mastermind evaluation. We are essentially putting a massive, globally recognized blue chip stock on trial, and we're going to judge it using the incredibly strict, time-tested frameworks of some legendary investors. Our subject today is an absolute titan of the beverage and snack aisles. So grab a notepad because we're about to dive deep into the numbers. Okay, here's our roadmap for the evaluation. We'll kick things off with a quick company snapshot, then we'll pass the stock through our three billionaire judges, Warren Buffett, Peter Lynch, and Benjamin Graham. After that, we'll run some modern quantitative models and finally synthesize it all into a final verdict. Section 1. Company Snapshot. The suspect on trial. Right, so our contestant today is PepsiCo, trading under the ticker PEP. It's currently hovering right around $155 a share, and it commands a massive market cap somewhere between $194 and $197 billion. I mean, this is an absolute behemoth of a company. We're talking nearly $94 billion in projected revenue for 2025 and a trailing 12-month earnings per share of $6.37. Also, management just recently announced a 4% bump to their annualized dividend, bringing it up to $5.92 per share. They are returning some serious cash to their shareholders. Now, what makes PepsiCo so incredibly durable is its diversification. You see, they don't just sell sugary drinks. They basically own the entire snack aisle with Frito-Lay and Quaker. That dual structure is honestly a brilliant hedge against shifting consumer diets. So the company clearly has this scale, but is it actually a good investment right now? Well, let's bring in our first judge. Would the Oracle of Omaha himself, Warren Buffett, take a bite out of PepsiCo? Let's check his criteria. Now, what's really interesting here is that PepsiCo largely aces the Buffett test. Buffett looks for a wide economic moat, right? And PepsiCo's vast global distribution network, which spans over 200 countries, is a massive moat. Earnings consistency? Absolutely. In their Q1 report, GAAP EPS was up 27% and core EPS was up 9%. How about a high return on equity? With an annualized net income easily clearing $8 billion against roughly $21.5 billion in shareholder equity, they are generating an ROE near 40%. That is phenomenal. He also looks for strong owner earnings, which we're using their solid $5.3 billion in free cash flow as a proxy for. Really, the only slight hesitation for a strict value investor is the debt. With a debt-to-equity ratio of about 1.3x, we have to label that caution, because Buffett generally prefers companies that require little to no debt to maintain their operations. But as we know, valuation is everything for Buffett. He absolutely demands a margin of safety. So if we assume a fair value of around $160 based on that $5.3 billion in owner earnings, applying his classic 20% margin of safety brings his hypothetical buy price down to $128. At $155 today, it's undeniably a great business. But Buffett might just patiently wait for a dip before backing up the truck. Okay, let's move on to our second judge. Does PepsiCo fit into Peter Lynch's playbook? Lynch loves finding a growth story that Wall Street has somehow overlooked. The very first step in the Lynch framework is categorization, and Lynch would undoubtedly label PepsiCo a stalwart. These are your massive multi-billion-dollar companies that, they aren't going to grow 30% a year, but they offer incredibly reliable, steady compounding and thick dividends. You buy stalwarts for downside protection and steady gains. However, Lynch really prefers companies with low institutional ownership. He's looking for the hidden gems. Because PepsiCo is a mega-cap staple in the S&P 500, we have to assume extremely high institutional ownership. And that's actually a slight negative in his specific framework, simply because Wall Street already knows everything there is to know about it. But the true Lynch test is the PEG ratio. That's price to earnings divided by growth. Ideally, you want this number below 1. PepsiCo's trailing PE is 22.6x. So if we use forward analyst projections of around 6% EPS growth, we get a PEG ratio of 3.7x. That's quite high for Lynch's taste. Because it's a stalwart paying a great dividend, he wouldn't hate the stock, but at a 3.7 PEG, Lynch would likely categorize this as a hold rather than a screaming buy. And now brace yourselves. We are moving to our final, and by far most unforgiving qualitative judge, Benjamin Graham. Can PepsiCo survive his famously strict old-school value checklist? Let's run it through the defensive investor checklist. Adequate size? Well, at nearly $200 billion, that's an easy pass. Strong finances and earning stability? Pass. Dividend record? They have an incredible, continuously growing track record. Pass. But here is the breaking point. Graham demands a moderate price-to-earnings ratio below 15 and a price-to-book below 1.5. PepsiCo currently sits at a 22.6 P/E and a price-to-book ratio near 10, given a book value per share of around $15.63. It catastrophically fails these last two. If we actually use Graham's legendary intrinsic value formula, which is the square root of 22.5 times earnings per share times book value per share, we get an intrinsic value of just $47.33. Just let that sink in for a second. With a stock trading around $155, there is absolutely zero margin of safety in Graham's eyes. He literally wouldn't touch it. But to be fair, this also highlights how strict old-school asset-based formulas often really struggle to capture the massive intangible value of modern global brands. I mean, PepsiCo's moat isn't just in its factories, it's in a century of mindshare. So the old guard of value investing is pretty skeptical of the current price. But what do the modern quants say? Let's shift away from the qualitative gurus for a minute and run the discounted cash flow and alternative quantitative models. Time for some explicit math. So, the absolutely crucial point here is setting our assumptions correctly so you can trust the model. We're pulling our data straight from the recent ticker model analysis. We start with a base free cash flow of roughly $5.3 billion. We project a fairly conservative revenue compound annual growth rate of 3.5% through 2035 and a net income margin of 12.4%. Now, for the gaps, we're applying an educated assumption for our discount rate, or WACC, at 7.5%. That reflects the low volatility and blue chip nature of the stock. And for the terminal perpetual growth rate, we're going to use 2.0% to basically mirror long-term historical GDP growth. If we stress test these numbers, tweaking the discount rate and terminal growth, look what happens. Even with a much more punishing 8.5% discount rate and a meager 1.5% growth rate, the model still spits out $170 a share. That's already above today's price. But right in the middle is our base case. $218. The quantitative DCF model suggests a fair value of $218. At today's price of $155, that implies a massive 40% upside. That equates to roughly a 7.5 to 8% annualized return over the next 5 years. To the quants, PepsiCo looks like an absolute steal. Let's back this up with a comparable multiples analysis, pitting Pepsi against its eternal rival, Coca-Cola. Coke currently trades at a trailing PE of 26.5x and a forward PE of 25.1x. PepsiCo is demonstrably cheaper across both metrics at 22.6x. Now, yes, Coke does have higher gross margins, but if PepsiCo were to see its multiple expand to match Coca-Cola's 26.5x, its fair value would jump to roughly $168 a share. It is clearly the more attractive relative value play in the beverage space right now. Finally, let's run a dividend discount model, or DDM, since PepsiCo is such a legendary dividend payer. Using their expected $5.92 dividend, assuming a cost of equity at 8% to match historical market returns, and a long-term dividend growth rate of 5%, based on their consistent payout increases, the math points to an implied value of $197.00. The sheer power of PepsiCo's cash return to shareholders easily supports a much higher valuation than where it sits today. Section 6. Synthesis and verdict. Putting it all together. Just look at the divergence here. This brilliantly illustrates the fascinating tension in modern investing. Benjamin Graham is screaming sell at $47. Buffett and Lynch are telling you to hold or maybe wait for a dip down to the 120s. But every single modern cash flow and peer-based quantitative model, from comparables to DDM to the DCF, indicates the stock is undervalued, with fair value targets ranging from $168 all the way up to $218. So why such a split? Well, it really comes down to how you weigh the operational strengths against the very real macro risks. The bull case is firmly anchored in their snacks and beverage diversification, incredible pricing power generating that $5.3 billion in free cash flow, and clear data showing their North America Foods volume recovery is actively underway. But the risks, they are non-trivial. Management specifically noted the potential for geopolitical commodity inflation. They are carrying a 1.3x debt-to-equity load, and of course there's the looming specter of GLP-1 weight loss drugs shifting consumer habits. Though interestingly, Pepsi notes this might actually boost their low-calorie and functional hydration lines. Taking this full mastermind evaluation into account, our final recommendation is a blended hold to moderate buy. If you are a strict value purist who demands a steep margin of safety, you should probably wait to see if macroeconomic turbulence pushes the stock down toward Buffett's $128 target. However,
If you're a long-term investor seeking steady compounding, the 155 entry point is heavily supported by the quantitative models and offers really compelling long-term upside.
We'll leave you with this final thought for today's explainer. In a market where forward-looking cash flow models confidently scream buy, but the battle-tested historical value legends whisper wait, which master will you choose to follow for your own portfolio? Thank you so much for joining us as we unpack the numbers, and we'll see you next time.